Forget reps. The short-term rental loophole can get you the same benefits without the full-time hours. I have clients with high W-2 earnings paying zero taxes starting with this strategy. And it really is the entry point into saving taxes and starting to grow your wealth, because it's often the first way that W-2 earners can tap into real tax planning without quitting their job or changing careers. So whether you're a high W-2 earner or own a small business, this strategy can work for you. So what is a short-term rental? First, let's talk about how the IRS classifies rental activities. Rental activities are by default classified as passive activities. There are two exceptions to this that can change that classification to be classified as non-passive and offset other non-passive income sources like W-2s, 1099s, K-1s, etc. So the first exception has two parts. The first one is the average period of 7 days or less on a rental period. And the second one is average of 30 days or less per rental period with significant personal services provided. The second exception is that you materially participate in the activity by hitting one of 7 tests. We'll talk more about material participation in a later video. But let's talk more right now about the first exception. So the first way that you can qualify for this exception is by the standard, most commonly known rule of having your average customer stay be 7 days or less. So if you have an Airbnb property and you rent it out throughout the year and the average of all those stays equals 7 days or less, this meets the exception. The second way is by having your average customer stay be 30 days or less, but you provide significant personal services. Now, what is a significant personal service? This would be services that go above and beyond what you would normally expect on a short-term rental, stuff like hotel type of services. Both of these can turn a normally passive activity into a non-passive activity, which means you can offset your W-2 or business income with losses from that property. It is important to note here, the original 7 days or less would be filed on your tax return on a Schedule E. The 30 days or less stay with personal services would go on a Schedule C. Now, it's very important to understand that when you're filing a Schedule C, you're going to have to pay self-employment tax on any of income versus on a Schedule E. So be sure to talk to your tax advisor and make sure that you're planning appropriately for this. Now, let's quickly talk about how to figure your average stay. If you have 3 people stay at your property, and the first one stays for 10 days, and the second one stays for 2 days, and the third one stays for 7 days, you have a total of 19 days. You divide that by the number of stays, or 3 in this example, and you come out with 6.33 days per stay. So this qualifies. Now, say instead you have the first person stay 10 days, the second person again 2 days, and the third person stays 10 days. Now your average is 7.33. This would not qualify. Now, why does this matter? Because it unlocks bonus depreciation in the year that you put the property in service. Now, typically you're going to depreciate a rental property over 27.5 or 39 years. Bonus depreciation allows us to write off a significant portion of the property in the first year. That portion is determined by having someone do a cost segregation report. That report breaks out things like furniture and fixtures, flooring, or landscaping into buckets that can qualify for a significant upfront deduction. But be sure to check out my videos on depreciation and cost segregation for more details and to make sure that you understand how that works. But for an example, here is a cost segregation study on a property that was purchased for $385,000. The cost of the land was allocated at about $40,000. And from the cost segregation report, we can see that $101,000, almost $102,000 of bonus depreciation was broken out from the rest of the house. So that was about 26.5%. Plus, we have the regular first year depreciation of $8,800. Notice here, this is a 39-year depreciation because that short-term rental is technically a business now instead of a residential rental property. Now, let's say you're a married couple and you have a W-2 income of $200,000 and you use the standard deduction of $30,000 for 2025. With the first year depreciation of $110,000 and say a $6,000 rental loss on income and other expenses, then your first year, your taxable income would be $53,000. Now, based on these figures for 2025, the tax on that would be $5,924. Now, that's compared to $27,228 for a savings of $21,304 just on this one short-term rental property. Now, in order for the property to qualify as non-passive, you must materially participate in the activity and meet particular tests. As I mentioned before, there are 7 tests to determine material participation. For short-term rentals, the most common is the 100-hour test. So if you spend more than 100 hours on the property in material participation activities and more than anyone else, then you qualify for the short-term rental loophole. Now, this is very important. You have to track not only your own hours, but the hours of anyone else, because that 100 hours has to be more than anyone else has put on that property. Examples of hours that count towards material participation would include improvements and repairs, marketing and advertising, and general property management. What does not count is things like education and research, and normally travel time does not count. For more details on material participation, please check out my other video. Now, let's talk about timing. We also need to understand what placed in service means. If you had a long-term rental, the date placed in service would be the day that you had it ready to rent. But for a short-term rental, we need to have someone actually stay there to determine if the average stay is 7 days or less, right? So it is recommended that you have a minimum of 3 stays in order to substantiate that to the IRS. Here are some common mistakes that can happen when it comes to a short-term rental property. The first one is converting your personal home into a short-term rental property too late in the year. If you live in your home for the first half of the year and then you turn it into a short-term rental, then you're already at 180 days for your stay. And when you average that against all other stays, it's going to be way more than 7 days. Secondly, failing to track your hours. You must have your hours tracked either by hand, on a calendar, or in a spreadsheet, or in an app that tracks that information. Number 3, hiring a full service property manager. This causes you to lose your active status because by definition, they're spending more time on that property than you are. Number 4 is forgetting to separate the land versus the building costs for depreciation. Land is not depreciable, so you cannot write it off. Short-term rentals are one of the fastest ways to start reducing taxes today. But to keep those deductions, you need to understand passive versus non-passive income. And that's exactly why we're diving into that in the next video.